The next thing, the supply and demand. So 2 years ago, developers stopped developing. We had a guy there that was like, dude, like we have a lot of stalled projects. As a matter of fact, it was hard to get. It's been very hard to raise the capital for rate for development, and some of the existing stuff is what he was talking about. And it was weird because we were in a meeting and he was like, look, I'm listening to these bankers and stuff like that on the stage. So yeah, we have access to capital, we're lending, we're doing this, and he's sitting there as a developer, like, and a major company, not just some small rando company. He's like, I don't know what they're talking about. That money that they're saying is available has not been available. Like we're having a tough time getting it. So we're hearing two stories here, right? So I'm telling you, the supply and demand issue is very real. There's a lot of projects that started, that stalled, that are not happening. People weren't able to get capital. They didn't start new projects. So within this 2 year gap of 2006 to 2027, there's not a lot of new product coming to market, which means any current properties that are brand new, they're stable, people are not raising the rents because they don't want to lose tenants. Soon as this 2027 happens, because people are going to start, the money's going to get a little looser. They're going to start developing again. So you're going to see rents are going to skyrocket in 27, 28, all the way through 29. Because if they start developing in 27, that's when a new product is going to come to market. So there is going to be a supply and demand gap, right? There's going to be limited supply for the amount of demand for renters because I'm going to say it. I said it there. I continue to say it. I'm going to be preaching this message over and over and over again. Like the golden age of a home being a good investment is dead. Houses and homes right now are typically just a commodity. They're like toilet paper, corn, wheat. You don't need it. I mean, it's a baseline thing. You're just going to use it. It's like a utility. So people that were going off to buy a home and using it as an investment because that was a bank product saying, hey guys, I think it started in the 20s. A home is a great investment. It's not anymore. All right. We know that. So renting, renters by choice. We're not talking about government housing and people who are struggling with the affordable housing, right? We're talking about affordable rent, like things needs to be affordable, but affordable housing is a different program. It's a government or a federal program. People are running to that right now. That's fine. But the supply, people want to rent in great locations, great properties, great assets with a pool, the amenities, near shopping, near jobs, near growth, near in great neighborhoods, great areas. Um, that's who I'm talking about. That segment. There is a major demand for that. And there is going to be very limited supply. So if you're investing in multifamily like we are, into areas where the rent demand is massive, and we can get into these properties early, this next 12 months, 18 months, we're going to have the values of these properties are going to skyrocket. Because when I do my math, rent in this country doubles every 10 years, which means values in this property in multifamily doubles every 10 years because it's measured by the rents. So next, which I went through the rent skyrocketing, right? So next we'll go through the Trump effect. People love him or hate the guy, but he's a real estate guy. He's always going to lean on the real estate side. He's built his bones in real estate and branding and development and things like that. Right now, Eric just became the billionaire through basically crypto. I like to say Bitcoin, but it's not. But like the Trump effect, people doing it. The tariffs, the taxes that he's bringing in, the businesses that he's bringing back, the threats that he's using, because really tariffs are a threat mechanism. It's a mechanism you can use to threaten people and get what you want from it. He's using it. So he's going to do good for real estate. He's going to do good for real assets. His family's doing good for Bitcoin and alternative investment opportunities. The tariff stuff, he's using it. He brought back bonus depreciation. Now, it killed some jobs and it also made some jobs. So, but what it does do for you and me as real estate people, real estate investors, whether you're a passive investor, you want to invest, or you're going to be doing this yourself, real estate is going to get the benefits of what's called the Trump effect. Period. End of story. That's happening, whether we like the guy or we don't. Last but not least, there's a glut of inventory. All right. So there's a lot of inventory. I talked about it a second ago where you're going to have these groups that own hundreds of thousands of units. I think one of the guys we talked to had 40,000 doors and they were looking at offing about 1/3 of their portfolio. So that 1/3 of that portfolio is legitimate, right? Like that's quite a bit of units that he's going to be like, hey, look, this part of our portfolio, we need to get rid of these assets. Not because they're bad, but because it's time. The debt was 5 years on a floating interest rate, meaning that rate is floating up and down. So at some point, the time is up. You got to get rid of it. It's been 5 years. You're going to refinance or you're not, or you're going to go ahead and off them like what he said they got to do so they can get rid of those assets, pay their investors back, and then move into new assets. So, like we said, they're going to refinance, they're going to sell, they're going to take that capital that they're getting and they're going to push that back out into the marketplace. So that glut of inventory is happening right now. It's been there, but it hasn't been able to move because buyers and sellers have been at a standstill. So that's the major opportunities of why what's going on. So number one, rates got lowered. Number two, and I wrote this down, there is that $2 trillion of debt maturing. Number three, the taxes. The benefits of the bonus depreciation, 100% bonus depreciation actually coming back to real estate. Next, the supply and demand issue that we are seeing between 2025, 26, 27, and then the skyrocket of new product coming to market, right? Will also create massive opportunities. Rents are going to skyrocket in that time just because of the supply and demand issue. Because again, people are already seeing what's happening. Houses aren't selling, sellers are in a standoff. There's more sellers than buyers out there. Housing is not going to come down. More people have like 80% of the mortgages that are on single family homes, their interest rates are sub four, below 4%, meaning that they're at 4%, like 3%, 3.75, 3.5, 2%. Like those sellers don't need to sell. They'll sell. Everybody's a seller if they get what they want. And if you are a buyer and you can't get a great price, you're gonna rent, which is why I'm saying that rents will continue to skyrocket because if I can rent for cheaper than buying, I can get a multi-million dollar pool, multi-million dollar community center. I'm in a neighborhood where the zip code of the property that I live in, the community I live in, of multi-million dollar homes, million-dollar homes, and I can live there for cheaper than it would have cost me to rent and not have to put 20% down on a home, get a mortgage to be stuck at that property for 30 years. I'll do that all day. All right. That's my pet peeve on on single family houses and homes as an investment. So next, the Trump effect. The Trump effect of what's going on with the interest rates, him pushing. And remember, Trump is going to push, right? Like Jerome Powell's out. He's going to be out. He's going to lower the rates. At some point, his term is going to be up. Trump's already going to put one of his boys or girls in there, and he's going to push them to lower the interest rate. So the interest rates will come down. So the Trump effect, love him or hate him, he's a deal guy. He's a real estate guy. He hates banks. He hates high interest rates. He's for this country, and that's going to be a benefit, like we said, to business owners. They're going to be able to do more, make more, and they're going to be able to take that money and move it into real assets outside of their business. So their investment opportunities are going to be bigger and they can take advantage of the tax advantages, which are in place. And you should be able to take advantage of the tax benefits going on if you're working your ass off like everybody here does in this country. So next, the glut of inventory. That glut of inventory is going to make opportunities, but it's not going to be in single family. It's going to be in multifamily and other asset classes that are in real estate, multifamily specifically. That is the one that people are hanging on to because people will always need housing in this country. Period. End of story. AI can't change that. I don't care how much AI, Nvidia, Bitcoin you buy. People still need homes. That's why I chose multifamily real estate as the number one way to build wealth in for my family. And hopefully it is for you and your investor and for you if you're one of my investors and if you're doing this yourself for your own family. So next thing I did, long-winded, but I wanted to do this. Super important. And granted, guys, I talk fast. I do. Stick with me, or you can rewatch this video. Here's the deal. If you're looking to multiply your money, multiply your investment, you're looking to create generational wealth for your family. You're looking to take $1 million and turn it into $2 million. You're looking to take five and turn it into 10, or you're looking to take 500,000 and turn it into $1 million over time. Pay attention. This is huge because you got to do these things. This is how you take advantage of the massive opportunities that's going on in this market right now, right? So number one thing is you need to protect your capital. Do not put your money into these fixer-upper, beat-up, shitty properties. I'm not saying they don't work. I'm just saying that money cost less a couple of years ago. So a lot of those opportunities have escaped you. You're going to have to shift your investment mindset, your concept, your principles about investing and invest in a higher class of assets. That's exactly what I did. As soon as the market and interest rates change, we automatically stopped looking at value add deals and we raised our bar on the quality of assets. Because if you're going to get the same return on the asset, then get an asset that requires less work, less sweat equity. Just go ahead and buy a nicer deal, even if you have to pay more for it. The returns are the same. So, number one thing, protect your capital. Do not put your money into a risky asset. Just get something that's easy peasy. Boom, let's go. That's protect your capital, which is the deals we look at. 150, 200 units, 250 units, class A locations, class A plus properties, A minus properties, already cash flowing, already filled, already nice, already renovated. All we have to do is raise the capital, invest and buy the deal and collect our money and continue to ride the inflation wave for the rent. That is the game, right? That's how you protect capital now in this market cycle. Because again, this is the beginning of the opportunity. This cycle will continue to run for another 10 to 20 years, I promise you. So, first things first, protect your capital. Do not lose it. Number two, you want to invest in the right location, the right asset. Do not question that. That is the number one thing I look at right now. Every broker I talk to, they're like, "What are you interested in? What's this cap rate sensitive?" I'm like, "I'm not. I'm location sensitive. I want to get the best location we can get." The location is really the play because if you have the right location with the right size asset, someone will always want that asset. Another group will always go, "No, we want that location." How many of you guys have drove by a property and you're like, dude, that property always failing. There's some corner, some retail building, and it's always vacant. There's something, a business comes there, it leaves. Business comes there, it leaves. You're like, dude, that's like a revolving door. Why? It's the location. It's not the property. It's not the tenant. It's not the market. It's nothing. Because I can also say there's probably some place where you think in your head, like, just think about your city. Where's Boardwalk and Park Place? Where's Main and Main? Where's the best location you know you want to live there? Period. If you had the opportunity to buy it 50, 100, 20 years ago, if your grandparents would have bought it, you know that your family would be rich right now. Right? Like those are the deals you want to invest in. It's location. Number one thing, right asset, right location. So first, don't lose money. Number two, invest in the right location and the right asset. Number three, three, you want to invest for passive income and cash flow. You don't need a whole bunch of cash flow, but you want to put your money in a place that does have passive income and it gives you positive cash flow. After it pays the expenses, after the debt, and it pays you a return on your money. And you know you're not going to lose your money, so you're good. You can focus on keeping your main thing the main thing, which is how you made your money in the beginning, which is your business, your job, and you can focus on taking care of your family because you don't have the time to look back at your investments. Like you need to invest with somebody like me who that's their full-time job so you can focus on your full-time job, which is your business or your job and working and taking care of your people, right? But you're investing for passive income and cash flow. That's number one. That's what, three, four. Let's just say four. You want to invest in something that we can control the appreciation. I said it earlier. As the rents continue to rise, because I believe rents double in this country every 10 years, every time I look statistically, that's where they're at. You can know that there's some level of appreciation. You can't, like right now, they're talking about Dow Industrial with the Treasury holding steady at 4.1. You can't dictate those things. If you buy a bunch of stock, if you buy Nvidia, if you buy Tesla, you buy Apple, you buy Meta, you buy ABC stock, you can't do that. The Mag 7 controls, I think it's like 80% of the stock market right now. It's holding up the SP 500. Like you can't do anything about that. There's no control whatsoever. You can't force that. All you can do is buy, hope, and pray. But if you invest your money into a multifamily deal, we know we're going to raise the rents $50, $75, $100, $200, whatever the market can bear as it relates to inflation. Right? Rents in this country have continued to go up since 1945, and they will continue to do that, I believe. As a matter of fact, like I said, it's not just that we're becoming a renter nation, it is more accepted, right? Everybody has already accepted the fact, like, hey, a house is a bad investment. I'm going to rent until I'm ready to buy. And when I buy, I'm going to buy what I want, and money's not going to be an issue. But during that time, you need to own the best assets in the best locations. And because you're able to increase the rent, you're able to control the appreciation in that asset. That's what you need to be investing for nowadays. And next, the tax advantages. You need to take advantage of the tax advantages, right? So as you're investing in a deal like ours, multifamily, real estate itself has the best tax advantages of any other asset class out there. Period. End of story. That's what I believe. Period. Right. Knowing that you get to make money, like let's say you earn money from your business or your job, your profession. You take that money. This thing is flashing in and out because of this dumb ad, but you take the money that you made and you invest that money in an asset that one, it cash flows, two, it gives you appreciation, three, you get the tax advantages. So you are now protecting your capital and keeping more of what you made because you get the tax advantages. You can write off years of your passive income. You get to write off, sometimes it offsets some of your other income from your other businesses. And then when you sell, you also get the tax benefits depending on how you exit that deal. Whether you're doing it with us, we have tax benefits and advantages of that, or you're going to do this yourself. That's what you're looking to invest for. And then last but not least, I talk about this, but I talk about it in a different perspective directly to my investors, is you need to think long term. I bring this up because as we were at this event, a lot of people there, especially multifamily, is an illiquid asset. It's an illiquid investment. You're going to invest in it. You need to think long term, right? So if you're 30 years old, you need to be thinking all the way up to like 70, 80 years old, and then dying and passing it on to your heirs. Like you want to continue to stack racks, period, in your multifamily investments with us, other people, whatever. And then you just want to think long term. 3 to 5 years is not long term. 3 to 5 years is short term in multifamily real estate. If you're doing larger deals, if you're doing an eightplex, duplex, fourplex, 10 unit, 20 unit deal, 5 years, 5 years is still a long time. But it's not long term if you're thinking about investing. That's short term. You got to have a plan. At some point, you're going to get into a 20 unit deal, refinance, take your capital out like I did, resell the property, and then later roll that property. But you're going to get into big deals. And if you stay with a 2 unit, 4 unit, 8 unit, 10 unit, 20 unit mindset, then you don't get used to what long term investments really is. Long-term investments are 10 years, 20 years, 30-year holds. There's Japanese companies and companies over in Asia that have a 100, 200 year, 1,000 year horizon. You need to think like that as an individual. As an individual, you need to think like a company or a corporation. Your family itself is a company, it's a corporation, and you are the CEO of it. So as you take your capital and invest, you need to be thinking long term. I wanted to hint on that a lot because as we move into this next cycle of opportunity and you're going to take advantage of these things with me or on your own, think about number one, do not lose money, make cash flow. Take advantage of the tax opportunities that are being afforded to you so you keep more of what you make, so you double down on your investments, right? And then last but not least, think long term. Control the controllable opportunities, and you can last if you can last long term if it's making money. Like that makes a difference. Do I want to be in this investment for 10, 20 years? Every deal I look at, I'm like, dude, do I want this thing for 20 years? Will my investors make it over 20 years in this deal? Could we get destroyed? Could a building come and could something happen catastrophic and knock us out? Do we still want it? That's why I look at newer, nicer properties. Because if the deal's 5 years old, 20 years from now, it's only 25, right? Would you rather date, if you're a woman, would you rather date a 70-year-old man and hope to be there till he's 80, or would you rather date a 25-year-old man and then in 10 years he's only 35? Trust me, man, things break. So and they break a lot sooner when you're old. So, anyways, I said that to say this: think long term as an investment, as an opportunity. That's the major investment. So with all the opportunities coming up, and these are the ways to take advantage of them, I want to invite you to do it with us. All right. Bell Capital, you can go to bell-capital.com. You can register there. You can take a look at our open fund, the open opportunity, the documents, how we do it, what are our fees, how I do it, and you can schedule a call to talk to myself or somebody on my team about investing with us. All right. You have to be accredited. You got to have a great attitude. You already got to love real estate, and you got to think long term. That is the requirement for us because everything I do is long term. So I'm here for you. I hope this helped you. What did you take away from this? If you got to the end, you're already on it, man. Keep showing up. But I'm doing this for you guys because I want to share this information. What are the major opportunities and how do you take advantage of them if you're going to be an investor? My suggestion for you, the only way to create wealth in this country is to be an investor. And how do you become an investor? You invest. Period. End of story. You got to get started somewhere. You do not have to be the person that owns the deal. Investing in a deal still makes you an owner. That's how this works. So all you people out there, oh, I got to do it myself, man. 100%. I don't want 100% of everything. I'd rather 1% of something big than 100% of something small. Because you also get with the 100% of something small, all the big headaches that go along with it. Right? If you're a passive investor, you get no headaches. You get those phone calls with us, and we just let you know what's going on with our opportunities, and you continue to get that check. That's what we want to send you. That's my goal. Anyways, let me know if you need anything. Bell-capital.com. Leave me a comment. Give me a thumbs up or give me a thumbs down. Don't be a hater and a hider because I'm here for you. I'm going to continue to be here for you. And we are expanding right now. And I'm going to push right through. Watch what I'm saying. Over the next 12 to 18 months, you're going to look back and you're going to either wish you did something or you're going to be grateful that you did. All right. Have a great day today. Let's get after it. And boom.